Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we need to talk about portfolio construction. What are the key building blocks that you need to build a good portfolio? A good portfolio is something that can help you to retire, to build financial freedom, quit your job, do whatever it is that you need to do. I'm going to give you the key building blocks to do that. Now, this is not a here are the things you need to invest in type video. It is what are the things you need to invest with type of video. If you're looking for that, like, I don't know, top stocks for June, best defensive stocks in the market, all that type of stuff, we have all those things. We have more than 400 videos to help you to become a better investor. But to become a better investor, you gotta have the right tools. And to do that, we are going to discuss those building blocks today. All right, so in the investing world, as of today, and will probably not change in the near-term future, you have 3 different account options when it comes to a taxation perspective. You have tax deferred, you have tax-free, and then you have taxable. You should have all 3 of those things whenever possible. The reason why is because when it comes to tax flexibility, you don't know what the tax rule is going to be every 2 years. I say every 2 years because you got midterms, presidential elections, everybody's got their own tax plan. They want to change that all the time. The tax rules changed in 2017 and the game is different. And the game is going to be different in another 2 years. The game is going to be different in November. And so it's going to change, which is why, again, you want to have your money in all 3 buckets. The reason why you want to have that other than tax diversity is because each type of account that is available to you has different rules, different regulations, and different parts of pieces of flexibility, and that's going to become important too. So I'll start with the tax deferred and kind of move through the list here. Tax deferred means that this is money that I can put in now and not pay taxes on until I'm ready to pull that money out and retire. Generally speaking, that's going to be like 59 and a half, which means that I'm investing primarily for the long term. It also means that this is a traditional IRA that counts as a tax deferred vehicle. This is a 401k. This is a 403b. Usually, with the exception of a traditional IRA, this is stuff that I can only get through my job. Now, that is a very powerful tool and mechanism. I get to lower my tax burden today. Right, so if I'm putting in, and these limits change. Let's say I'm putting in almost $20,000 into my 401k every single year. That means that my tax bill, theoretically goes down by at least $20,000. They don't get to tax me on that, which is great if you live in a high tax space where they're trying to tax you now. It's like, look, nope, that doesn't count because I put $20,000 in my 401k, I put another $6,000 in my traditional IRA. That's $26,000 that you cannot tax me on until later because those taxes are deferred. That is why you want to have it. Again, this can help you to compound that wealth, again, without taxes until you are ready to pull the money out. Now, the other good thing too is that I may not control to a degree. Let's say I get paid $100,000 a year. I'm gonna get paid that $100,000 a year, and that's just it. When I'm ready to withdraw, I don't have to withdraw the entire amount. If I only want to get taxed $1,000, I'll only pull out $1,000. So I get to control to a degree of what my tax bill may be or could be in the future by using those tax deferred accounts. I would say it's each one of these structures can be extremely powerful when used the right way, but you want to take care of that tax deferred bucket. It is the easiest one, I think, of all of them, because if you have a job and have a 401k, you check the box, you're already there, right? You've already done that. But again, 401k, traditional IRA, you got to have that. And this is usually, but not always, usually the one that gets the company match. If that is available to you, it makes it one of the most powerful vehicles. That's why you see so many 401k millionaires, because you get to put the most money in without paying taxes. And that is usually your biggest asset outside of like your home. Okay, so that's number 1. You got to have something that is tax deferred. The next one is having something that is tax free. This generally only encompasses a Roth IRA, unless you have the blessing of having a Roth 401k. Now, when we say Roth, this is, again, a tax-free vehicle, can be a tax-free vehicle. What that means is you are taxed today at your current rate. So, for example, I get my paycheck, okay? I got that gross, and they hit you with the net, right? That difference between those two, you've already been taxed. So I've already been taxed on it, which means Roth IRA, this is for you, right? And it means that I can put my money inside of that vehicle, invest it, and when I'm ready to pull it out, now for Roth IRA right now, you have to be 59 and a half. You have to have had the account for at least 5 years. If you meet those two criteria, you can pull that money out tax free, which means that let's say I'm in my 30s or maybe I'm in my late 20s, that means I can invest for 20 or 30 years and not pay taxes on the growth of that account. Keyword on the growth, because you already pay tax on the money you put in. So that means that for 20, 30 years, let's say if it's something like a Google or Microsoft. Remember I talked about Microsoft. Well, if you were on Instagram, you saw me talk about Microsoft. So for example, at one point last week, Microsoft ended Internet Explorer. It's a tangent, but I promise you it's gonna make sense. So you put in $100 a month into Microsoft from 1995 up until the end of May. If you did that, $100 a month, you'd have more than $600,000 at the end of May of 2022. Well, a lot of that is straight growth from investing in Microsoft. Imagine having $600,000 that is not taxable. That'd be great, right? You've already paid taxes because you paid tax on that $100 already. You put it in for 27 years, it grows $600,000 free and clear of taxes. That's something that most people would like to have. So the taxable, the tax-free bucket rather, you've got the Roth IRA, and some employers offer a Roth 401k. Okay, so that's your tax-free bucket. Then you have the taxable bucket. This is probably the one that is underrated. This is the account that has no tax benefits now. However, you can put in as much as you want, and you can take out your money whenever you want. Now, you will also get taxed every year as well. But when you see people that say, oh, I'm a millionaire, I've hit FIRE, right? What does it stand for? Financial independence, retire early. And I'm like, but how are you investing and living off your investments, all that kind of stuff? Because I take advantage of the taxable account. That is usually a taxable brokerage. Like right now, public is only a taxable account, which in some ways is good. I can put money in, take money out, and do whatever it is I want to do. I am not locked into only pulling it out at 59 and a half. There's no penalty for me to withdraw my money now if I chose to. So that is the benefit of it. So you want to have each of those three things to build your portfolio with. The reason why is because, number one, it offers you tax flexibility, or tax diversification is a technical term, but it also gives you a different layers to pull from as you are building out your investments and as you are growing your wealth. For example, even for this, like when I bought my house, I didn't want to have to pull from my Roth IRA to have a down payment. I didn't want to pull from my 401k. I could have, but I didn't want to do that. I could just say, hey, look, I've got, $50,000 here in a taxable brokerage that I can use whenever I want to. I can sell off just a little bit, pay for a house if I want to, and allow my other tax advantage accounts to continue to grow. That is how you want to use things. If you want to leave your job early, if you've invested well enough, you can start with the taxable, then move to tax free, and then tax deferred, and really stretch out your plan for financial freedom and really build your portfolio in the right way. You almost never want to have all of it in just one bucket, because should something happen, you are beholden to those rules. And what you don't want to do, I've seen this happen for divorcees, people who run into extreme emergencies where they have to liquidate a portion of their retirement. If I have a taxable account, I can pull it from there. In some cases, it may make sense to pull for something that's tax-free, because in a Roth IRA, as of today's rules, you can pull, if you put in $6,000, you can pull out $6,000. Now, the only thing you have to worry about is the gain on that $6,000. But whatever you put in, you can take out of a Roth IRA. That is, in a worst case scenario, something that I could consider, but I don't have that option if 100% of everything is in a 401k. So again, just having those options is something that you want to have available to you. If I were to rank these and you were to ask me which one is the most important, honestly, I always lean more to the 401k. I know it's old. I know it's more traditional. I know it's not the fun, most sexy thing, because you can only invest in what your company allows you to. However, I'm looking at the amount. I would rather be able to invest $20,000 a year, and that limit changes every year, and people could be watching this many years into the future. But let's say that I can invest $20,000 a year and that amount is going to grow. I'd rather have that at my disposal and say, hey, I've got $100,000 that I've built over 5 years, than I'm only putting $6,000. That's the only thing I do inside of a Roth IRA. That's not going to add up, right? Even though it's important, even though you should have it and it's important, I'm going with the money where I can get a match and I can put in the most possible. However, what I like to do is try to attack each of these boxes as simultaneously as I can. So if I can say, look, take 15% of my paycheck, put that in a 401k. If I can invest, let's say, I don't know, $100 a month into a Roth IRA, and then my brokerage, my taxable account, put $100 there every week or every month, whatever feels comfortable. I'm checking each of those 3 boxes. As my salary grows, my income grows, I can increase these amounts across the board. But the thing is, the way that you want to have this is have those different places for you to pull from. You want to be in your bag financially and say, oh, this is happening, I can use this account. Oh, this is happening, I can use this account here. This is happening, my wealth is still building because I'm doing X, Y, and Z. When you have those bones, you can build on top of that and choose the right investments for each of those. Because remember, each of these accounts have different rules. So in my mind, in my 401k, I can pretty much only have index funds. That's fine. That's my long-term money. I'm not getting taxed on it. Perfect. Put that on autopilot, right? If I have what I think are extreme growth stocks, maybe you feel this way about Tesla. Maybe you feel a certain way about, I don't know, Google or whatever you think. SoFi, let's take that one. That can be the next big thing. Imagine being able to invest in SoFi. And I'm not trying to get you to buy any of these stocks, but just giving you an example. What if I could buy SoFi now and it grows and becomes the next JP Morgan? Imagine doing that now in a Roth IRA and not paying tax for the next 20 years. If I could know that, that's what I would do. I would put it in a place where I'm not going to get taxed anymore on it. So you want to have that bucket taken care of. And then you have your brokerage where you can do whatever it is you want to do. Index funds make sense for all of these, but your brokerage account, maybe if you can tax loss harvest, and if you lose money, write a little bit off of your taxes, not a whole bunch. But I can be more flexible. I can say, maybe I put my dividend stocks there. Maybe. Because I can use that money now and take care of certain things. Again, there are a lot of things you can do with a taxable brokerage account, but those are the 3 areas that you do want to consider. Have those 3. Okay, you don't even have to put no money into it. You should put money into it, and you should absolutely invest with the money that you put into each of these accounts. But at least have one open. Okay, at least just have one open. So I'll put my link for public in the bottom, in the comment section below. I think they give you like $20 or something like that to start. If you haven't already, many of you have met me through public, so we got new people that may not have. So that's number 1. If you haven't had that already, if you're looking for a good place for a Roth IRA or a traditional IRA, Fidelity is one of my favorites. They don't pay me for that, but they are, because they don't have they do have fractional shares. TD does not, for whatever reason. I don't understand that. Another good place is Charles Schwab. I don't have any personal experience with them, but I've had great things from my clients. So that is another place. Then your 401k is your 401k. Can't help you there. Sorry. But those are the things that you want to consider, and the building blocks that you have to have a good, successful portfolio. You want to have options, and you are not going to know what situation you're going to be in next 10 to 15 years. The key is having those things in place already. If you're depositing a small amount, investing small amounts now, perfect. As you grow your income, you're going to have even more. You have even more choices because you've already built the habits, you already have the accounts, and you already have the structure there. All right, that's it for me. Talk to you later. Bye.